So I say this: if you're one person who's concentrating high on returns, I want the bond to return a high return, I wouldn't say buy a junk bond. I would say get a mutual fund or an index fund or exchange fund that concentrates on junk bonds and spread the money across the bonds. Have that fund, look into the perspective and the investment criteria of that fund, and to see which junk bonds they are investing in. And you know what? It's a higher return on those bonds, but there's more of a risk. But when you spread the risk amongst more companies, it's still risky, but it's more of a precaution. So if you are the one who's rushing for the high return and wants to do a junk bond, never buy a junk bond individually. Buy junk bonds through a fund that spreads your money out. Usually, I've been doing research on the indexes and the funds that purchase the junk bonds, and usually those indexes and funds, the share prices of the bonds are $100 minimum, 100 and change and stuff like that, and you buy it in multiples of that. It's that high because bonds are $1,000, so it stays at that steady price usually, and it fluctuates, but every index or fund that invests in bonds are always going to be listed at $100 or higher. Now, corporate bonds, those can be from your Walmarts, your Disneys and stuff like that, more safe and stuff like that. They're going to offer less of a return, but there's more stability in that. So me personally, I say this: I'd rather you take some of your money and put it in corporate bonds and some of your money and put it in government bonds. Government bonds also offer tax breaks. Usually they're only taxed on a federal level. Usually you're offered free city and state taxes on the income you receive from the bonds. And so that's my recommendation: corporate bonds and investment and government bonds. And I say on the spread of how you should invest in those bonds, I would do a 60-40. If you're more aggressive, 75-25. 75% of your money in corporate, 25% of your money in government bonds. Because government bonds you pay for that. What you're paying for is the stability. So it's not a lot of growth in it, So lower more of your money in corporate bonds, who's going to offer you a higher interest. And the reason why you like getting bonds from a strong company versus their stocks are more generated towards speculation and have that value of the company, where bonds are the obligations of the company. And companies welcome getting bonds from people because they choose their interest rate versus them borrowing money from a bank, who tells them, okay, I'll loan you $1 million at 7%, 8%. They could turn and go to the public and say, listen, I want to borrow $1 million from you guys, and we're giving you 3.5% on that $1 million. Now, on your $1,000 bond, you're getting 3.5%. You check your local banks for $1,000, they're giving you less than 1%, 1.25%. You're like, my local bank's only giving me 1.25% on my $1,000. I might as well get 3.5% from this corporate bond, and you're happier because you're getting a higher return. The corporation's higher because instead of paying a 7% interest to the bank for the $1 million, they rather pay you 3.5%. They get their money cheaper, you get more money on your money, and everybody's happy in that scenario. Now, the government bonds, since they're stable and it's considered almost guaranteed, they'll probably, if they're offering 3.5% on a corporate bond, the government bond is probably offering 2.6, 1.75, 1.8, 2.0, and the numbers I'm spitting out to you are just examples. government bonds interests are usually higher than your banks anyway. The banks, you know, I only seriously feel leaving money in banks is just to pay your bills, and it's better than keeping money in your mattress. But as far as using a bank as an investment vehicle, banks hold your mortgage. Banks hold your money you need to pay your bills in, and that's it. Money, as far as your investment, your money should be elsewhere. And people always say, "Oh, banks are steady, banks are steady." This week, excuse me, 8 banks were closed in several states. And you know, you might think, "Oh, there's so many banks, that's not a big deal," and stuff like that. For banks to collapse, that's a big deal. You know what I'm saying? That's high mismanagement of people's money. For banks to collapse, because you know the Federal Reserve backed banks and the FDIC backed banks, and for them to still collapse, this means recklessness with people's money. And that's your livelihood. You think these banks are guaranteed, and they're closed on you. So I'm going on a tangent to come back into it. That's how I feel about bonds. And you know what? I'm going to wrap up this vlog on investment grade bonds and how you should approach them and what do they mean to you. I'm going to do another vlog more detailed about bonds, but you got to tune in to the next vlog. Once again, people, thank you for tuning in. See you at the top.